Good day, students. Continuing with the revision lectures on stock exchanges, today we'll cover the topics. One is the trading procedure in secondary market, and then we'll also talk about depositories and demat accounts. Okay. So we learnt about IPO process in the earlier lecture, which is a process for raising initial capital. This is implemented by a company wanting to raise capital through shares. We said that once the shares are sold in the primary market, the company is now listed in the stock exchange, and then investors can start trading with their shares. Please note, in the secondary market, new capital is not raised. It is just the investors who trade with the shares they have. Now, how do they start trading? What are the procedure? What are the steps involved? So below are the steps for trading on a stock exchange. The first step is selection of a broker. So likewise, what we studied in commodity market, here also the first step is selection of a broker. The buying and selling of securities can only be done through a SEBI registered broker who are members of the stock exchange. So again here directly the investor cannot go through the stock exchange. So it has to be through a SEBI registered broker. The broker can be an individual, it can be a partnership firm or a corporate body or a financial institution. So the first step is to select a broker who will buy and sell securities on behalf of the investor or the speculator, right? Once this is done, the next step is opening a demat account with a depository. So selection of broker and opening a demat account, these two are one-time activities. So opening a demat account with a depository. So depository is basically an institution which holds the investors' shares in electronic format. So these days we know that banks keep our money, and depositories similar to banks, they keep our shares. They keep track of the shares that the investors purchase or sell. However, unlike banks where we can directly open an account, to open an account with a depository, you need to go via somebody. That person is known as a depository participant. So there are various members who are attached to a depository, which is a larger institution, and there are various members of the depository. They are called depository participants. And these depository participants or DPs help the investors. Many a times the broker will act as the DP as well. So mostly the broker will be a DP as well. Okay. In cases if the broker is exclusively a broker who just handles transactions in shares, he invariably will have a tie-up with a depository participant who will support him. Okay. So after opening a demat account, the third step is trading or placing an order. Now this trading procedure is a routine procedure, and once you have a demat account, orders can be placed through a broker. So investor can consult the brokers, can go through various websites, can also look at news, and then he can place an order very clearly specifying the price range at which he is okay to buy or sell securities. So you'll have to be very specific, stating buy 100 equity shares of Reliance for not more than 500 per share. So this is one sample. So keeping this as the basis, the broker has to ensure that he follows the instruction strictly, right? So the instruction or the order, placing of order can be done over phone or email or any other mode. Then comes execution of the order. Now broker has the order from the investor, and now he executes the order through the ETS system or the electronic trading system, because now he is authorized to execute the order. So once the order is finalized, the broker issues a contract note to the trader with the details of the transaction. So once he executes an order is finalized, whatever has been the transaction details, that is given in the form of a contract note to the trader. Okay. So post this, the final step is the settlement step. Settlement step is basically, if the share is sold or if the share is bought, that is reflected in the demat account, and whatever money transaction has to happen, even that happens. So there are two kinds of settlement. One is on the spot settlement, which is called T plus 2 day settlement. In the sense, if on Monday the trading happens, by Wednesday the transaction is settled. I mean, if the shares are purchased, it is reflected in your account, and if the shares are sold, even that is reflected in your account, in the account of the trader. I mean. Then the second type of settlement is called the forward settlement. Here settlement takes place on a future date. It could be T plus 5 or T plus 7. That is, if transaction takes place today, maybe 5 days later, the settlement happens or reflects in the account. Stock exchanges are open from Monday to Friday, and trading usually takes place between 9:55 to 3:30 in the afternoon. So now we move on to the next topic, which is on depositories. So we already mentioned about depositories and opening of demat account in the previous topic. So let us talk about depositories a bit more in detail. So depository is an institution that holds the securities of investors in electronic form, or that is called demat form or dematerialized form. The primary function of a depository is to transfer ownership of securities from one account to another after trade has been made. In fact, trade and settlement has been made. So a depository provides the services to investors through its agents called depository participants or DPs. These agents are appointed by depository, and we are aware of it. They are members of depository, but they are appointed with the approval of SEBI. According to SEBI regulations, among others, 3 categories of entities, that is banks, financial institutions, and members of stock exchanges registered with SEBI, can become depository participants. So as I told you, a depository participant can be a broker as well. In fact, what used to happen earlier was that shares were traded in materialized form, that is, hard copy of shares used to be exchanged between buyers and sellers. Okay, so now with the popularity of online trading, the securities are converted into this kind of electronic form. A depository acts as a bank which holds securities like stock, mutual funds in electronic forms. There are two institutions, major institutions in India, which act as depositories. One is NSDL, or National Securities Depository Limited, and the other one is CDSL, that is Central Depository Service Limited. Okay, and okay, so with this we'll move on to the next topic. Continuing with depositories, we'll talk a little bit more about NSDL and CDSL. Okay, so I've given this as a comparison. So abbreviation of NSDL is National Securities Depository Limited, and CDSL is Central Depository Securities Limited. NSDL was founded in 1996 and CDSL was founded in 1999, and both are headquartered in Mumbai. The promoters of NSDL are IDBI Bank, UTI, and so on. For CDSL, it is HDFC Bank, SBI, Bank of India, Bank of Baroda, and so on. Now, NSDL is a depository attached to NSE, or National Stock Exchange, and CDSL is a depository attached to BSE, or Bombay Stock Exchange. Now, currently, as per the figures I have, the demat account value with NSDL is around 1.7 crores. With CDSL, it is around 1.6 crores. Okay, so this is, if you're asked specific question to distinguish between NSDL and CDSL, you can use this. And even if a short note is asked for any of the depository, give an introduction and talk about the specific depository. Moving on, the final topic for today is understanding the terms dematerialization and rematerialization. So we spoke about demat accounts or shares in demat format or dematerialized form or electronic form. So dematerialization refers to the act of transforming physical shares the hard copy physical shares in paper to an equivalent number of shares in electronic form, and transforming this and transferring this into the investor's demat account. So this is dematerialization. Now what is rematerialization? So rematerialization is an act of converting the shares. It is ulta of dematerialization. So whatever shares you have in electronic form in the investor's account, that is converted into physical form. So see, there is no restriction on trading in physical shares, but it is not done very commonly, but there are occasions where physical shares are used. So dematerialization is converting shares in electronic form, and rematerialization is from electronic form to actually issuing hard copy of the shares. Okay students, with this we'll continue with some more topics in the coming sessions. Thank you so much.